Hello everyone, welcome back to another episode. In my opinion, Vanguard ETF investing and investing in Vanguard index funds is the most popular way to invest. When I do my mentoring calls all the time, one of my highest recommendations that I can give people for investing is to invest in one of these two. It's either to invest in VTI, the one that we're especially going to be focusing on in this video, or it's to invest inside of VOO. Now, if you haven't watched my previous videos, I've made videos about VOO before, and VTI and VOO both are Vanguard ETFs that have very similar performance over the long run. You can see VTI is up 39%, and then VOO is up 44% in the last 5 years, and they have relatively similar dividend yields. So in my opinion, VOO should be weighted a little bit heavier in your portfolio over VTI, and I'll be going over the reasons behind that in this video, and we'll be even breaking down the holdings in this, and I will be going over their website, and the website will give us everything we need to know to the percentages, the weightings, the performance comparison over the S&P 500, and also just anything in general that you need to know about the ETF. But in this video, we'll be going over VTI like I went over. We'll be going over the Dow index. The Dow is switching up some of its 3 companies out of the 30, so 10% of the index. So this is a pretty big mix-up considering that this index is the most recognized index other than the S&P in the entire world. So I'll be going over the 30 companies, what it means for the stock market, and I wanted to just show the first like 8 or 9 seconds of this clip because I think what Jim Cramer said in the first couple of seconds of this video describes it perfectly.
First, the real shocker here is an oil company coming out and a cloud company coming in.
So pretty much what he just said there in one sentence pretty much wraps up everything about what I was wanting to say with this Dow switch up, and I'll be breaking down the details towards the end of the video. But switching out an old, boring, nasty oil company for a new age cloud company is a huge shift for the Dow, and I'll be going over my reasons for that and also how it might be affecting your investment with VOO or VTI, and if this will have any changes to your portfolio. So overall, guys, a quick intro to me. If you're not familiar with me and my channel, I track my annual dividend income, my monthly dividend income, my portfolio value, and my YouTube income is all disclosed. I disclose everything in the channel. I even show my YouTube income. I show all of my positions in my portfolio. I can share this pie. It is in the description right here if you want to go check that out. I have 29 holdings, and I'm currently up on nearly every single one of them. I am a dividend investor. That's what I'm primarily focused on, and we're doing very good in the portfolio. And one of the ways that you can support me, if you appreciate the transparency and you're interested in supporting my channel, we have now had 24 people successfully sign up using my referral link. So if you want to go ahead and go down below in the description, you want to go ahead and check that out for yourself. There's lots of other information in the description as well. So if you want to check that out, go ahead and go into the description. You can get $10 just for signing up, and it is 100% free. So thank you guys so much, and let's go ahead and dive straight into VTI and compare it to VOO. So when we go to VOO here, and we type in their ticker symbol, and we scroll down, we type in the chart, when we scroll down, we see that they have 515 holdings. And the reason why it is called the Vanguard S&P 500 ETF is that it is supposed to give an exact replica of the S&P 500. This is going to perform nearly down to the exact percentage what the S&P will. The only difference is you get charged a very, very teeny tiny expense ratio. But the thing is, in my opinion, the reason Vanguard index funds are so popular, if you see something that is an exact same counterpart, which is SPY, the Spider ETF for the S&P 500, compared to Vanguard index funds, their expense ratio is so much higher. Vanguard, the VO, has a 0.03, and then the SPY has a 0.09. So 3 times higher in expense ratio, which is also why it's lagging a bit, behind VOO because they have such a great expense ratio, and VTI is no exception as well. Well, you see that it has a 0.03 expense ratio, and then VTI has a 0.03 and a 1.66 dividend yield, almost identical. Now, I wanted to go over my reasons why VTI has 3,500 holdings versus VOO's 500. So basically, the only real differences here is that you're extremely more diversified. Now, the funny thing is, these are all in U.S. stocks. If we go to VOO here, and we type in VOO, the S&P 500, that is only U.S. companies. So 98.99% of the company right here is in United States stock. And then if we go to VTI, let's see if it's the same thing. When we type in VTI, you can see down below that it is also 99% U.S. stock. So the same thing, not a bunch of foreign investments, nothing sketchy. And I wanted to go over why they own 3,500 companies rather than the 500 in the S&P. And will you perform better in this or in VOO? Now, in my opinion, I'm a huge fan of blue chip stocks, and that is a big component of the VOO, which is the S&P 500 ETF. And now I'm on Vanguard's website, and I'm going to go over everything that you need to know about the fund. This is going to give a bunch of basically just snapshots of the ETF and the statistics behind it, and how it's performed and compared to other Vanguard index funds. So it has a low expense ratio, it's extremely diversified, and you can see its yield computed right there as of July 31st of 2020, the net asset value, the market price, everything you need to know. And you can see the main thing I wanted to focus on here was the performance compared to the S&P 500, the Splice Total Market Index, which is the S&P 500, and this blue line here is the Total Stock Market ETF, or VTI. This line is nearly identical. 6.44 versus 6.47, 10.04, 10.04, 10.02, 10.03. You get the point. These are nearly identical. You can see that the only reason that VTI is a very, very teeny, tiny bit difference is because they have that super small expense ratio, which is almost non-existent. It's not even worth it. When you're investing in a company like Vanguard, which is one of the oldest, most reputable firms in the entire country when it comes to the stock market and securities in general, Vanguard and the Vanguard index funds are the most popular, and for good reason. They have great expense ratios, and they overall just have great ETFs to invest in. And you can see their diversification here. Total stock market ETF as of July 31st, and this is the percentage versus the benchmark as of 7/31. 2% in basic materials, 2% in basic materials, 8% in consumer goods, 14.5% in consumer, 15.9% in financials, 13.9% in healthcare, 11.8% in industrials. Oil and gas, only 2.4%. Technology is now a high-weighted 26.7%. Telecommunications, 1.7%, and utilities, 3.0%. One thing, though, a lot of people have argued about with SPY and VOO with the S&P 500 is that tech is becoming the largest sector by far. Now, I think that's fine. There's nothing wrong with that because tech is arguably the fastest growing sector compared to pretty much anything else out there. But in my opinion, that is pretty high, even with VTI being as diversified as it is. But you still get a diversification between multiple different sectors. And in my opinion, I'm glad that oil and gas only makes up 2%. I would be completely fine if only made up like 1%. But anyways, that's a different story. I'm glad that consumer is very heavy in it. Financials, healthcare, these sectors are so important for not only compounding interest through the form of dividends, but also growing share prices, because some of the companies that make up the biggest weight in these categories are some of your largest name brands in the world, and you can see their top 10 holdings right here. Diversified between different holdings, like I said, while it is heavy in tech, and different positions as well. Apple makes up the #1 position in the portfolio, Microsoft #2, Amazon #3, Alphabet, or Google essentially, #4, Facebook #5, Johnson & Johnson #6, Berkshire Hathaway #7, Procter & Gamble #8, Visa, one of my favorite holdings, #9, and then United Health Group #10. This basically makes up the S&P, but the only difference is that you have a lot, and I mean a lot, of very small cap stocks that are $1, $2, $3 billion, and that makes up the extra 3,000 holdings. Now, if you make the mistake of clicking portfolio and management and seeing all the holdings in this portfolio, because they have to disclose everything, they show every single stock that this portfolio earns, and if you go to their total holdings here. Okay, and now it sorts by their top 3,500 holdings, and you see it sorts from greatest to largest. And I'm just going to slowly scroll through some of their top holdings. I'm not going to name them off one by one because that would take way too long. You can pause the screen at any time. I'm just going to scroll through some of their top holdings. If you see anything that you think is interesting, or anything that might be an issue, or might be a pain, or might be awesome to own, you can look at this and look at its weighting through VTI, and this is some of their largest holdings. Now, while I'm scrolling through this, I wanted to tell you guys something. This is one of the reasons why I'm not a big fan of investing in ETFs, specifically in Vanguard ETFs, because everybody loves them, and I do too. I'm the hugest fan of Vanguard. I love their company. I love what they have to offer. But in my opinion, the reason why I don't like owning the ETFs is for this reason. I'm scrolling through these companies, and do you notice something? There's some of the names that you probably notice in here. You probably notice some great names as I'm scrolling through, like I see General Mills. That's a good company. DocuSign, that's a great company. There's lots of great companies in this list, but the thing is, there's so many companies that I've never heard of, or companies that I don't like whatsoever. Walgreen Boots Alliance is one that's struggling, for example. That is a stock that I have to own if I want to buy into VTI. And when you're buying this ETF, you're not just buying the largest holdings. you're buying every single holding that is pretty much the largest 3,500 companies in the United States. When you're buying into this ETF, you don't have a choice to choose between getting rid of one or getting rid of another. When you're investing in individual stocks, you can easily swap out one for another if you don't like their business model, if you don't like the direction that the company is moving, or pretty much anything like that in general. But when you're investing in ETFs, a lot of your say in where your money goes gets taken out of the decision making with investing. ETF investing is great. I'm definitely not taking anyone away from it, but in my opinion, it is just not for me. So in my opinion, I like to invest in VOO because you get a lot of the higher growth stocks that are blue chip stocks that have been around a million bajillion years, like Coca-Cola and Pepsi and Caterpillar and stocks like that. But when you're investing in a lot of these smaller holdings, a lot of them are very struggling companies. A lot of them are companies that you've never heard of. A lot of them have stagnating business models, and it's not really something I want to focus on. I would rather invest in companies that have the most fantastic management teams. I'd rather invest in companies that have great business models, companies that have growth opportunities for not only this year and next year, but have growth opportunities for decades out. Like, for example, I'm scrolling through here, Halliburton. That's not a stock that I want to own. That is not a stock that I'm interested in owning, so I don't want to add this to the ETF. But you can scroll through here. If you want to go to their website, you can see all 35 holdings. I'm not going to scroll through them all. That would take a million years. But basically, guys, if you're interested in owning the ETF, you have to remember that you're not just owning one stock. You're not just owning the ETF. You're owning all the holdings inside the ETF, which is 3,500 holdings. So considering the fact that you're going to be investing in all those stocks that are so far down the list, your money is spread out so thin. It's almost like owning just a teeny tiny little piece of everything. And in this point, when it's 3,500 instead of 500, it's split so thin that it gets to the point where it's almost like you barely own anything of anything. So, in my opinion, guys, I would rather just invest in individual stocks, but I will give you their investment strategy. The Vanguard Total Stock Market ETF is an exchange-traded share class of Vanguard Total Stock Market Index Fund, which employs an indexing investment approach designed to track the performance of the CRSP U.S. Total Stock Market Index, which represents approximately 100% of the investable U.S. stock market and includes large, mid, small, and micro cap, keywords there, and micro cap stocks regularly traded on the New York Stock Exchange and NASDAQ. Though the micro cap stocks are included in this instead of just the S&P. So in my opinion, guys, I think that the performance will be very similar to VOO. So investing in VTI is still one of my highest recommendations for investing in it. But in my opinion, if you had to choose between VTI and VOO, in my opinion, I'm going to go with VOO. And there's a reason why it's slightly outperforming VTI and has a slightly higher dividend yield as well. But either way, guys, investing in either one is not going to really be a mistake. The only real difference here is that you're a lot more diversified with VTI versus VOO. That's really the only main difference. But either way, guys, if you're watching this video, do not get discouraged. If you want to invest in my portfolio, like I said, it is shared in the description. If you want to learn more about individual holdings, you can do that. But investing in any one of these ETFs is a great positive for your investing strategy. Investing in these are almost guaranteed to make money in the long run. Because like I've always said, investing in these, when you're investing in the S&P 500, people always tell you, oh, investing in the stock market, that's really risky, right? You could lose all your money. But when you're investing in the S&P, the only way that this goes to zero is if the United States collapses. Is if the United States goes to zero, is if the United States goes bellies up, defaults on all of its obligations, and then VTI and VOO will go to zero. But other than that, it's going to continue to thrive in the long run, pay dividends, reinvest through its retained earnings back into its businesses, and you are guaranteed to make money in the long run if you hold in the stock. Investing at any point, you know that in the future, it might take a week, it might take a decade, but eventually you're going to make money if you invest in VOO or VTI. And now I want to go ahead and wrap it up by getting my opinion on the Dow index and show the three that it's taking out versus taking in to the Dow index. So you can see that they're entering Salesforce, Amgen, and one of my holdings, Honeywell, and I do not own any of the other 5 companies. Just Honeywell is the only one that I own, so the only one that's affected from this. And the exiting the Dow, we have ExxonMobil, Pfizer, and Raytheon. So in my opinion, I wanted to go over just some basic information and how this might affect VTI, or basically the index in general. So how the Dow is different from other indexes, this little category right here. The Dow is one of the major 3 indexes for investors. Policymakers and businesses use it to gauge the U.S. stock market as an indicator to where the U.S. economy is headed. So these 4 words right here are key. Where the U.S. economy is headed. So who chooses the stocks that are in the Dow is actually the Wall Street Journal. They pick companies that make up the largest part of not the stock market, but the largest part of the economy. So you'll see why some of the companies on here are some extremely huge large cap like Apple, and then some companies are a little bit smaller cap, but they make a huge moat. They're a huge moat in the economy. So these are the 30 stocks right here. It is 3M, and by the way, I think it's like 12 of the 30 in this list. 3M, American Express, Amgen, Apple, Boeing, Caterpillar, Chevron, Cisco, Coca-Cola, Dow, Goldman Sachs, Home Depot, Honeywell, IBM, Intel, Johnson & Johnson, JP Morgan Chase, McDonald's, Merck, Microsoft, Nike, Procter & Gamble, Salesforce, Travelers Companies, United Health Group, Verizon, Visa, Walmart, Walgreens Boots Alliance, and the Disney Company. In my opinion, of all 30 of these companies, I think that they are all some solid picks. And you see some of them, like when you look at Procter & Gamble, which is one of the companies that I own, 1932. 1932 is when this was initiated into the Dow nearly a century ago. And they did just get rid of ExxonMobil, which was the oldest holder in the Dow, which was over a century ago. So a huge switch up to the Dow. And I wanted to let you guys know that this is not going to be affecting the share price. This is not going to be affecting the Dow. The only thing that it's really doing is believing in these future companies more to grow the Dow quicker rather than these three laggards, especially ExxonMobil in my place. Now, why this is so big? It's talking about not what is the largest cap stock, what's growing the quickest, but what makes up the largest part of the index as far as the economy growing. What makes up the largest moat in the economy? And for the people at Wall Street Journal, for the people that make up the Dow, Salesforce is now going to have a larger moat in the economy over the next decade, 2 decades, versus ExxonMobil. I mentioned to a lot of people in the past, I do not invest in energy companies. I do not invest in any big rigs in oil. I think that oil companies should not be invested in, regardless of what dividends they have to offer. And I think that the Dow is seeing this. You see that they're getting rid of old nasty oil and getting into the new great awesome cloud companies. I think that this is incredible. I think it is a perfect move by the Dow. And I think when you look at Exxon and see that they have over an 8% dividend yield, about 8.5%, you can see that this is inevitable, that it's going to be cut. And do you want to be investing in companies that are down almost 50% in the last 5 years and don't see any real recovery in sight? That's not for me. So in my opinion, I think the Dow is making a great move. But overall, guys, that pretty much wraps it up for this video. If you're interested in supporting me and my channel, like I had to mention, I track my annual and monthly dividend income. I track this charts and update it every month. So if you want to see a full real-time portfolio growing day by day, go ahead and sign up and subscribe. Go ahead and check out the description. So maybe you can get signed up through M1 Finance. Descriptions in the link. Portfolio is shared in the description. Everything you need to know, guys, about my portfolio is shared in the description and shared publicly through my video. So if you want to ask me any questions, go ahead and leave a comment down below. But overall, guys, I think if you're investing in VTI, anything with Vanguard index funds, you're going to do great in. And I think this is a great move by the Dow as well. And I think it is going to do great for my portfolio. Considering that Honeywell will be getting at it, I think it'll be great for Honeywell since they will get more attention since they are now recognized in the Dow and they will probably be getting invested in a lot more. So a great pick there for me. But that pretty much wraps it up for this video, guys. Go ahead and leave a comment down below what you thought about this video, and I'll see you guys next time.